Hi, it's Paul, and as ever, it's...
Megan?
That's our signature now, isn't it? So today, we're going to have a chat with Debbie here, who's an investment director at Evelyn Partners. We're going to talk about the economy. We're going to talk about all things to do with inflation and interest rates, and it's really interesting.
Yeah, I think we're going to call this episode Economics Revisited, following on from our first episode we did with Debbie in season 1. So if you are wanting a bit of a prerequisite for listening to this, I think, is to go back and listen to Debbie's first episode and just get an overview of what she thought of the market back then. I think it was about 6 months ago. And then we chat mainly about the inflation rate and
government policy, Bank of England, Monetary Policy Committee. As we know now, we've had interest rates paused after 14 consecutive rises. Next rates review by the Policy Committee is in November, and we get Debbie's view on that. Not financial advice, but all the same, some really interesting insights. So without further ado, here's Debbie.
Okay, so we're here with our returning guest, Debbie here from Evelyn Partners, who is the investment director there, to chat through all things economy related, kind of economy revisited, I think we're going to call this episode.
We like this. I'm looking forward to this, I'm very honest.
Yeah, I think this was your favourite episode of season 1.
Yeah, I mean, we've already had the podcast before we switched the microphone on. We've already had the debate, but we're gonna dive into it. Debbie's fixed the economy. It's all good.
Great. So we're a year on from the infamous trust budget, or the mini budget it was at the time, which obviously led to the massive economic turmoil, including the hikes in interest rates and things. So we just kind of wanted to bring Debbie back and chat through what that kind of effect is. So we'd mentioned in the first episode that there was a 9-month lag. We were but
yeah, we were debating that, weren't we? You said 9 and then you were saying there's a school of thought which says 18 now, but it's somewhere between. But what we have seen, as we know, is we've seen a pause in interest rates after 14 consecutive rises. Rates have been paused, and there is a debate that we might be over peak inflation. In fact, there was news today again about food inflation, wasn't it, coming down. So just be good to, just good to get your thoughts, really.
Yeah, I think, I hope you're right. I hope we are past peak inflation. We've obviously come quite a long way since October. So October 22 was the height, and that was above 11%, which is quite a thought, actually, when you look back now.
When you think about it.
And we're now down at, the last read was 6.7%. So still high, but definitely moving in the right direction. And I think last time I spoke, I kind of suggested that interest rates were a wee bit of a blunt tool, and I do kind of maintain that that's due to kind of a number of factors. But I think major shocks to inflation that have kind of occurred as a result of the pandemic, that I probably spoke briefly about, but that have lent itself to a scenario that's not normalised as such.
No. Supply chain, wars in Europe, these things have kind of not really anything directly to do with rampant inflation.
Yeah, they're not. So we went from services, we went from goods during pandemic to services to goods. Arguably, we're back there again. We saw, I definitely mentioned the reduction in the labour force, and that's been apparent both in the UK and the US as well. A percentage of the population have left the labour force and just arguably not coming back.
No, it doesn't look that way,
so
despite all the temptations and pension rates.
The government are trying.
But that wage inflation, that has been, I mean, it's been mentioned a few times in the Bank of England minutes, isn't it? It still remains a concern that is too high because, as you say, shortage of people, so therefore those in employment can demand better salaries, apart from us too, but generally.
That's exactly right, and I think the UK is kind of, I don't want to say known for its striking, but that's something that we have to deal with as well across sectors. There's been a few shocks, and that's probably what's fueled the scenario we're in terms of lingering inflation, and it's hard to see some of those are kind of structural long-term changes. So the adjustments have been a bit slower, I suppose, and I'd add to that, I don't know if I mentioned this last time, but corporates and households kind of took the opportunity during the pandemic to refinance at lower levels. They had the time, rates were very low, so they did that. So that takes a bit of time to feed through. And Paul, we were just talking about the fact that mortgages are taking a little bit longer to roll off than maybe initially was kind of perceived, or there's a lot of talk in the media about, the kind of time bomb. It's not really the way it's happening. It's a bit slow.
I think so. It's ticking slowly, isn't it? And is it a time bomb? I mean, I think it's something like 2.2 or 2.4 million coming off fixed rates between now and the end of next year. Whereas we say we may, it'd be good to get your view later, we may start to see interest rates moving down the way by middle of next year or so on. So yeah, it will be interesting to see, but do you feel we're over the worst then?
Our gut and our kind of base case at Evelyn Partners is that we're hopefully, but there potentially another interest rate hike, but inflation is trending in the right direction, and that's the most important thing. And as long as, we caveat that there could be another shock, oil prices as one in there, but as long as things kind of continue as they are, it looks like the data is suggesting we should be okay. We should continue this trend.
That's good, and I think wage inflation seems to be cooling. Cost of services, which was another worry. Getting your hair cut, that sort of thing. Not something I have to worry about, but that again was quite high. But again, those seem to be turning as well. Next review's in November, isn't it, when the Monetary Policy Committee meet? Do you think that might be the one, or do you think they may take a further pause?
It's a bit anyone's guess at the moment, to be honest. I think taking pause for breath is the right thing to do, as it starts to feed through into the economy, and just letting that kind of have our moment to see how it impacts. But it's definitely a wait and see.
Because the economy's still fragile, isn't it? And if they go too hard, we could tip into a recession, which we'd like to avoid, or certainly a significant sharp recession, which would be really bad, especially with elections coming up and everything. It's, not that I'm being cynical, but it's
absolutely
it's
right. And I think once the focus moves away from inflation, as it does trend downwards, then the talk about growth is important. That'll definitely be a consideration when we do not want to really hamper growth in the economy. Absolutely not.
No, and we'll come on later to talk about Europe versus the US versus UK for growth. In fact, let's do that now. We're on growth.
Sure.
We're jumping around here a bit. We're in the flow. Who do you think's the best shape then for growth in the next, in the next couple of years? Who do you think that is?
Well, I think the US picture looks a lot rosier.
Yeah.
So if we look at Europe, they've really struggled. Europe has got the European Central Bank have got a really difficult job. There's a huge divergence across their economies. They're dealing with Germany is a huge export-driven economy, and I'll come back to that actually. But France, inflation obviously got to kind of similar levels as the UK. Most of us have kind of vague understanding of what goes on in France, so I'll leave it at that. And then Italy, if you look at huge indebtedness, that word I think it is. So quite different scenarios across regions, and that's what they've got to deal with. So their monetary policy, impacts varying regions. So it's a bit trickier. But performance-wise, Europe has done, from a market point of view, done quite well at the start of the year. They had a really good start to the year, and that was on the back of, there was obviously the concerns about their reliance on energy from abroad, so Russian oil and natural gas. So when it became clear it was a mild winter and they weren't going to go too far into their storage and it wasn't going to be a disaster, they kind of, having had a very difficult 22 performance-wise, has been fairly good. They're struggling a bit with this divergence across nations. And actually, if you look at recession risks and economic data, the stats are not great for Europe. They're kind of manufacturing's in contractionary territory, services data contractionary territory. So it's not looking great for the ECB. But although in saying that, I'd say they're pretty much close to interest rates being done as well. UK, it's a tricky one. We've got our partly labour market issues that you've already touched on. We also were impacted by the kind of Europe energy crisis as well.
Brexit, I hate to say this.
I'm glad you said it, not me.
I know that you want to stay politically neutral here, but I do wonder if there has been some impact at some level somewhere. That's all I would say.
I think most commentators, trying to be kind of sit on the fence here, but most commentators suggest it has to have had an impact. Our services have massively impacted in terms of labour shortages.
Yeah, that's for sure.
And we've all seen it, and you've gone on your domestic holidays and there's no chef in the restaurant, we've struggled a bit with that. But more recent data is a bit more positive in terms of growth, because the UK is always kind of shoved to the bottom of the pile in the G7, but that's not the case. So it could be better. And when we are looking at UK companies, it's a good reminder that the majority of companies in the FTSE 100 are overseas earners. So they're not dependent on the UK economy, and you know, it's so or the success of the UK economy, I should say. They're not dependent. Yeah, exactly. So you know, it doesn't mean that there's not good companies out there to pick from in the UK. But as I said, the US is definitely painting a rosier picture.
And why do you think the US is a lot rosier then? What would be the...
Well, they didn't have the energy issue. They had a lot more domestic energy supply, which helped them kind of initially take off the, you know, watch their inflation trend downwards. We've seen huge subsidies in the US to try and support growth. That's what Biden's done. There was I think it's a Chips and Sciences Act, and then obviously the Inflation Reduction Act as well, which is sinking huge amounts of money into the economy. So there's that, and it's the US, you know, they just always they lead the way into recessions, they lead the way out of recessions. It's just the way it works. And then the Magnificent Seven, I'm sure you've heard of these, kind of the big tech stocks.
The FANGs +2, isn't it?
Yeah,
now?
Exactly. They've done incredibly well. They had a really, you know, suffered seriously in 2022, but year-to-date performance has been exceptional. If you strip them
Tesla
out.
and Facebook, and you know the ones we're talking about here.
Yeah, it was Nvidia's the kind of the big one that's done incredibly well. So you know, they're US companies, and there's been a kind of focus in shifting. But more protectionism in the UK, so in the US, sorry. So that's kind of Biden's in a long-term view of the US to protectionism, security, and you know, domestic growth.
Yeah. Okay. So we're going to be second. So it's going to be the US, then us, and then Europe. I mean, might be able to go holidays. Might be a little bit cheaper in the future if the pound strengthens against the euro. We will see.
Yeah,
that's not what you're saying. That's my assumption.
Possibly.
That's not what you're saying. I get that. Maybe go to US instead. Great. So that's kind of where we are. And as you say, I think you've almost sort of given an indication where we think we might be going. I mean, if we look ahead to 2024. We've got a general election coming up in the UK. What do you see happening there? Does it have any impact on the economy? Is people pause? Yeah, I'm answering your question. Sorry.
No, it's fine. It's fine. Yeah, I think. I mean, you mentioned Trust-onomics, and we're about a year on from that. She's actually, I just was reading in the paper before I came here. She's back on the stage. She's at the Tory Party conference in Manchester. So she's got a bit of airtime. But I think she's been doing the kind of global stage as well. Yeah, she's been doing the circuit.
Talking about 40 days and 42 days, was it?
Yeah, there's a bit of, it was somewhere between 40 and
days, weeks. Anyway,
you
sorry,
can look into
that.
I think it's safe to say whoever comes into power is going to avoid a scenario like that. I think there's probably some quite important lessons that were learned there. So, you know, don't undermine the OBR, the Office of Budget Responsibility. Don't criticise the Bank of England, and don't sack your civil servants. So from our point of view, we don't think we would see extreme policies. It's not the right timing. So whether or not you agreed with her, you know, view on economics and on fiscal policy, the timing was wrong, and I think that's a fairly kind of common view. Yeah. Disruption in the bond market, that was our kind of biggest issue, or certainly on my side as an investor, that was one of the biggest issues. That kind of, she'd undermined confidence from international investors. That's a problem. So they would, you know, make sure that, and then that's what Sunak and Hunt came in to do, was to be kind of peacekeepers and to
steady hand on the tiller, stable things.
Yeah. So I think, I mean, whoever wins will have an impact on the economy because they'll change policies. So change is going to have an impact. But I think kind of we've recognised the importance of things like maintaining confidence.
Yes, yeah. I mean, as you say, after all this hard work has been done, it would be a shame if we went for something a little more radical. That's not really. I
don't see that happening. But I suppose right now there's a lot of talk on green policies.
Yes.
Sunak's obviously taken a step back. Kind of
5
backtracked. And Labour have always they have a green prosperity plan, but that was kind of spoken of last year. So who knows how much they can afford now with interest rates where they are. So, and I think they're. Not getting too political, it looks like there's a bit of kind of political manoeuvring and trying to push each party into committing to views and where they stand on these types of policies. So I don't think we'll see a repeat of last year, but it'll be interesting to see what the outcome actually is.
Yeah, and I think you just touched upon green policies there. I'm going to apologise for Megan because we're going all over the place with this discussion. Okay. Sorry, listeners. Is ESG and you know, is it still a major consideration when people are investing? Is that something that's high on people's lists?
Gosh, I hope so.
I mean, it should be, shouldn't it?
Yeah, I think in short, the answer is absolutely yes. I think we've probably been guilty of a bit of a short, medium-term approach because of what happened last year in terms of the geopolitical scenario. And that, you know, arguably is right. You know, we took a view, and we're seeing that kind of policy across developed nations. You know, this security of energy, and Sunak has backtracked a bit, and he's receiving, understandably, a lot of criticism for scaling back those net zero targets. But I mean, you could be either side of the fence here, can you? He's trying to be practical. It was always going to be controversial. I think when it comes to us, I mean, we saw net outflows last year in sustainable funds generally. That's been mainly driven by this energy focus.
So in layman's terms, that's people taking money out of that and sticking it into oil and gas.
Not necessarily into oil and gas, but just general kind of the trend away from sustainable funds or ESG funds, so environmental, social and governance factors. These that kind of angle, that tilt that we've seen for quite a long time now, that there was a reversal of that last year. And that is understandable given the backdrop. That's what
But you think that's only short term? I mean, the trend is still upwards, isn't it?
I think it's only short term. Climate change is obviously the biggest challenge we face as a society, whether it's a political football or, you know, regardless, this is a genuine challenge faced across developed markets, emerging markets, and we as a company completely believe in the consideration of these factors, so environmental, social and governance factors, when we're looking at companies. And it makes sense. You know, you want to avoid poor outcomes, and you want a company that's, you know, has longevity. We're long-term investors, so we're looking at the next, you know, 5, 10, 20 years, and you've got to be on the right side of this to be able to survive and to be successful. So we you know, it's very much a part of our day-to-day research when it comes to looking at companies. And I think realistically, and you know, to come back to the Inflation Reduction Act in the US, and we know we've seen a kind of equivalent Green Act in Europe, and we know about, you know, UK legislation. So we're very much still seeing huge amounts of money into this area. Things like just alternative energy, carbon capture, storage, you know, more efficient energy production and use.
It's going one way. We're transitioning, isn't it? And it's a painful transition, but we will ultimately get there, won't we? It's pretty clear.
Yeah, well, I hope so. I think technology might help us as well a bit, but ultimately...
I agree, Let's not talk about hydrogen cars now. Let's
But so I think I would say absolutely, it's really important. It's still a huge consideration.
Okay, that's interesting. Can I just ask you one more? Sorry, Megan, I'm hogging the mic.
No, not a problem.
Have we seen the end of QE? And who decides that? Is that a Bank of England policy?
So it's monetary policy. So it's the Bank of England or any other central bank buying up kind of government bonds, or to some extent they did do corporate bonds as well when times are really tough. So I suppose it's just a way of stabilising kind of economic conditions, so in kind of quite extreme cases. I think in theory, the requirement for it will be less so because we're hopefully going into kind of higher growth, higher interest environment. So requirement less so, but I don't see why there shouldn't be, you know, a scenario in the future where quantitative easing comes back. And I know it's controversial. I know some people think it obviously is contributed to this situation we're in inflationary wise, but equally it's you know, it was an economic crisis, so.
You haven't got many options at that point, have you?
No, but it's quite the opposite at the moment. We've obviously had the reversal of quantitative easing right now, trying to kind of that tightening and take that liquidity out.
Yes, quite. And so, as we take it out, as I say, the Bank of England's been pretty consistent in this, that they want to get us back to that promised land of 2%, which seems awfully ambitious if I'm, if I took a step back and thought about, but maybe that is
this arbitrary figure.
Are we going to get there?
It's quite an interesting one because it doesn't actually come from academic analysis. It was it genuinely was a bit of an arbitrary figure that came from New Zealand apparently, so I'm told. Right. I think realistically you've kind of got to stick with that target as a credibility issue, isn't it? You can't just move that target around as depending on the environment, but
you can move what's in the basket.
Yeah, you can. Sorry. Yeah, don't bring it back to the basket. Your meatless sausage, for example. Yes. You could, but I think central banks will just have to live with slightly higher inflation for the foreseeable. Realistically, that's what we think will happen. Yeah. And actually, looking back since the Bank of England became independent, which was late 90s, I think it was 98. They do have a reasonably good track record at hitting that. It wasn't as difficult.
But yeah. Quite.
So I think because of those structural changes that I mentioned before, kind of post-pandemic, I think realistically they just have to get comfortable with that slightly higher level. Yeah. But there's lots of factors at play, and you could talk about things like artificial intelligence or demographics. All of these things could have an impact that we've never seen before.
No.
So it's quite hard.
No, we are in like another industrial revolution, aren't we? Which is about, it's clearly not industrial,
but
it could be on that scale, couldn't it?
Yeah.
Really.
It could be, and you just don't know until the kind of the revolution starts.
Yeah. So 2% for inflation. So we know that potentially might mean that we have interest rates, not at the levels that we've seen. Go back to 2019, 2020. Because we're thinking about first-time buyers here, aren't we, Megan?
Yeah, so we're big champions about first-time buyers. We always shoehorn them into every episode. I think it's just, we just think they're a really important part of the property market. Obviously, you need new people coming in all the time. But I think the key thing that we wanted to ask you was something that a lot of first-time buyers really struggle with is the savings aspect. Obviously, you have to have quite a lot of savings to get on the property market just now. I don't know if you have any advice on what way people can make their money work best in the lead up to purchasing a house or making a big purchase like a property.
Yeah. Well, the one good factor that's come out of this scenario is interest rates are high for savers. So shopping around and looking it took a while, but right now where we are, so you can secure, for a 1 year term deposit, you can get quite a good rate on that. But I'd say shop around. As someone who had to shop around for the refinancing of their mortgage, it definitely pays off. Have a look around and see what people are offering. So and staying in cash when you're getting 4.5% or 5% on your, it's that's good. That's really good, and especially as inflation's trending downwards, so you're hopefully we'll be in kind of real earnings territory soon. I would say for those that are maybe got a little bit longer, there is this kind of short term. It's almost a window of opportunity in the gilts market. We've seen yields go up. As inflation rate expectations.
Just explain what gilts are for somebody that may not know what a gilt is.
Government debt, so debt issued by our government. But you kind of ultimately consider it a risk-free asset unless you think our government's going to go bust. Yeah. Should probably caveat that.
Some of the small countries where there's a high risk, you might go, that's too risky.
Exactly. Emerging market debt, it comes with a much greater degree of risk than debt issued by our own government. Yeah. So it is, if you're holding to redemptions, so if they'll give you a date that the particular gilt redeems on, if you hold it to that date, you're guaranteed your capital back at par value. So you know what you're buying at, you know what you're going to get. £100 when it redeems. So it's a nice secure way of kind of getting a bit of capital uplift. And in some cases you get a bit of interest as well, so a coupon on that gilt as well. Yeah. So I mean, depending on it's a attractive proposition right now. It's not been in the past. It's not been in my entire investment career, but it is at the moment. So you could look to that, but that's a bit trickier. You need a platform to be able to buy them on. But it's manageable. So if there's that. And I'd just say equity risk is not a risk you take on for the short term. So don't take any huge risk. Don't gamble with
don't trade
a deposit as a first-time buyer.
No. What about gold?
Yeah, it's quite a tricky thing and there's still volatility in gold, and there's no income. No. It's really a safe haven asset.
It's come to life a bit, hasn't
it? It has, and that's because of the risk-off environment. It still can be volatile in terms of price, and it's a trickier thing. It's generally ETCs, we call it, so exchange traded commodities. So it's a bit tricky. You can't just go and buy a gold bar, and well, you could, I suppose. You put it in your safe at home. You could. I think that we use it as almost a hedge against, geopolitical events or anything that could really upset markets in portfolios. I'm not quite sure on a short term or short to medium term basis. I would take I think it'd be taking a bit of a, don't want to say punt, but on the price of gold could be.
And we'll save the Bitcoin debate for another day.
Yeah, don't go there. Yeah. Okay.
So I think that is almost everything that we wanted to chat to you about, Debbie. I think just to wrap up, we were wondering, what do you kind of predict you see for the market over the next 6 months? Not to put you on the spot.
In fact, we'll be getting you back in, so we can mark your homework.
Give you some figures.
You've done well last time, to be fair, though.
It's all about inflation, isn't it, and what the trajectory is, and are we past the worst in interest rates? Have we peaked? Are we coming down? And that's quite a difficult question. Our base case, or kind of what our strategists are modelling for, is hopefully a soft landing, and there's caveats that come with that. But the idea that a recession won't be kind of long and protracted and deep, and when that will come, that's disputed as well. Data just now is still pretty strong, but likelihood is that we'll see a slowdown. But it won't be a massive recession, and that's how we are positioning ourselves in terms of our portfolios.
Okay.
So good. Winners and losers, as there always is in these scenarios. It's just about being selective about the companies that you're invested in. But
stability, I think, is the word you've used quite a bit today.
Yeah, well, that's what governments are hoping for. But there's a lot of kind of unknowns out there. Inflation, the path of inflation is, we have try and predict, but if you look back to late 70s, 80s, when they saw that kind of double header in terms of inflation coming back, and that's what we want to avoid. So they'll be very careful about.
They've said that they'll have to go harder for longer. They'll keep doing what they need to do. Won't
they'll do higher for longer if that's what is required, and that is the rhetoric right now. That's the narrative we're hearing from the committee members.
Definitely.
The central banks, across the US, Europe, and UK.
Yeah, I tell you what, it's really interesting to read the Bank of England minutes. I always do, because he actually brings to life the debate. No, it's really good.
No, it is interesting. We're very lucky. We have strategists who they will kind of digest that information and pick out the salient points. And it's interesting, and the tone often, and there's just a few very significant remarks that can could go unnoticed into the kind of unpracticed eye. So we're lucky we've got people that work on that for us and produce the information.
Maybe I'll ask them to help me out. But it was just very close last time, wasn't it? It was one vote in it for the pause. So again, we'll see.
Was it just one? Was it one? I thought it was more two, but just one.
Just one.
I'm sure you're right. Yeah.
Well, I don't know.
It was very close.
It was very. I think the governor had the final vote.
I
think that's how it went. So we'll see in November.
You read the notes. I read the summary.
I'm on first name terms. We're going to get him in next week. Well, listen, that's great, Debbie. I think clearly you've given us a real good picture. What we might do in the future now is we might just. It popped into my head when you were talking there. The sort of 101 stuff. Maybe we should do something on just. Like what a gilt is, what inflation is. We talk like everybody knows these things. Maybe we might do it.
Well, and you picked up on. Remember we spoke about the CPI and the basket of goods. And I'm saying I know over kind of the headlines of what if it's housing or recreation or culture, but actually what the underlying goods are. So there's lots of things that you think you
don't. I mean, who knows what's it? And the thing is, there's lots of different. Because when you look at, sometimes if I'm going to do a LinkedIn post, you look at inflation, and I go, which one am I actually looking at here? Because there's more than...
CPI and RPI. Yeah, the RPI is the one that I think it strips out mortgages. But and the government use these, depending on what they're looking at, they use, some pensions are linked to RPI. other things linked to CPI, so
No,
hard to keep up.
I had to look on what cost of services were, but then it seems to be people that provide services at a cost. That's what pretty obvious, really. So I was like what? Yeah. But yeah, okay. No, good. Well, we may do that, but whichever way, Debbie, that's been really good today. I've enjoyed that.
Thank you so much for coming on the show.
Oh, thank
Appreciate
you.
it.
Thanks very much for having me.
Cheers. Thank you for listening. I've got to apologise to you, Megan. I felt I hogged the mic there and asked most of the questions.
No,
so
not at all.
it's just I've got a passion for that subject, so my apologies. But we were thinking, weren't we, that maybe we might get Debbie back in for a sort of almost economics 101, because we're conscious we used a lot of acronyms there, so ESG, QE, and we're wondering if maybe we should do a little podcast just on some of the basics really of investment and also just on wider economics really. Yeah,
so if you've got any jargon you want busted, please feel free to send us an email at marketing@espc.com. We can get in touch with Debbie and arrange a future episode to debunk some economic terminology.
Indeed, please do, because we'd really like to do another episode.
So thanks very much for listening, and as always, if you like this episode, please leave us a review or a rating wherever you're listening, and otherwise we will speak to you next week.
See you again. Thanks again. Cheers. Bye-bye.
Bye.